Good morning, everybody. It's Market Michael here. It's May 9th. I'm going to go into reasons, or rather, problems with the current market setup. Okay, let's get straight into things. Excellent. Hello, guys. So, what did I see pretty much? Well, this is what I saw. Number one, we had that head and shoulders. I'm going to talk about the technical analysis behind the problems with this current setup that we got going on. So let's take a step back. Let's look at daily charts. We're on dailies across the board. Now, the first thing I'd like to point out, this market sentiment, or not sentiment, but sentiment, but rather price action has been not the best for the bulls, let's say. So with that being said, NASDAQ did the best. S&P did okay, but we did a double top here. And essentially that's what we're doing at the 61%. We're double topping at the 61 critical percent. Same thing with the Dow Jones except for the 38 at this point, and the NASDAQ is testing at the higher 78. Pretty interesting considering that it's not a critical point, but it's still important. Across the board, we're pretty flat. We got dojis across the board. Now, I tried to call that it was a morning star on May 7th, Monday. We got a transition candle Tuesday. I was unable to make any videos. Wednesday, which is today, we're getting a real doji, like a doji here that could shift that momentum. So I just want to bring your attention to the MACD and the RSI. Look at how we were trading pretty much for the most part on this part here, up high. Now we're down low. Same thing here, down low. MACD, tricks, same thing. We're down low opposed to up high. So, those are all reasons, to be in a bear market. This is being on the weak side. The bottom of that relative strength indicator means that it's no go. Same thing with the MACD. When the MACD is negative, it's a bearish sign. So if we can't break above that positive tricks MACD, and if we can't really stay at the top side of that relative strength, that just means that the market's weak. Overall, that's what we've been seeing. And although we have been seeing some bullish action from March to May, it's not enough to really convince me that this market's going to turn around and make new highs. If we do happen to break above higher highs, break these critical resistance levels, then I would say it's possible. But at the current rate, we're pretty much spiked out on the CCI. And the CCI tells me how much a stock moved and if it's worth how much it moved. For instance, we've moved up from this point up, right guys? We've moved up from this point, and that CCI is spiked out. So at this point, we're at the top of the range. Although the CCI can go more, because we're at the top of the range, it's time for the bears to start taking over. Now, the fact that we got that morning star 2 days ago, and with a transition candle yesterday, and another transition candle today, it's kind of telling me that the weakness is here, and that we're not able to pass these resistance levels, which are critical to getting higher highs. So with that being said, if we fail it and get lower lows, that's a bearish signal, and the bears are going to win. But we have to maintain that we don't know what's going to happen, and we have to maintain that this could swing in either direction. I would just assume that the markets can't do it, but Assumptions, when you assume something, you make an ass out of you and me. Get it, guys? You make an ass out of you and me. You see that? That's what that means. So we don't want to become an asshat. But at the same time, we want to be on that cutting edge of getting it right and wrong. We want to be at that cutting edge saying, well, this is a pivot point and direction needs to be taken, which we're saying that. Now, if we go to intraday charts, we're looking at really action that wants to be bullish. Look here. CCI spiked out a little bit. We want to go bullish, but I think that this market is going to have a hard time doing so. Very hard time. It's really struggling. And it should go to a bullish MACD here. But will it is the question. And again, if we really knock the socks off today, and if we pass through those resistance levels and make a lot of distance from that 50-day moving average, then I think markets could, reinstate a bullish price action trend. As of now, I don't know if that's going to be the case. As of now, I don't know. I would still say it's bearish for the most part. Intraday, this looks like it's going to gain support and keep moving higher. You know, the CCI is not too spiked out. And we're not that overbought. And that MACD looks like it's going to curl. But again, I think we're just going to have to wait and see. Now, markets overall, we should go ahead and check out some things here. The dollar's kind of rebounding after a rough morning. Gold had a little bottom at 1304-ish and kind of broke out. Didn't break out, but we smacked resistance and are coming back down now, as you can see. And now let's look at that 10-year, which had a big pop up this morning into that 3% range. So we've backed down a little bit, but it looks like we could get some support and keep rising. And that dollar looks like it gained some support at 92. But we're just going to have to wait and see where this trend goes. Where after this move right here, where's the support going to be held? Is it just going to grind along the bottom and continue higher? What's the deal? Let's look at crude, because crude had a pretty big rally from 40 to 70 over the past couple of months. And we want to examine that because it shows the geopolitical tensions around Iran and around oil. So oil intraday looks to be popping off. Let's look at a 180-day hour chart for oil. So again, oil's supposed to be coming down here. I expected oil to get in the 65s, but it had a complete reversal. We're going to have to see. We could get support at 70, 69. Definitely. And keep moving higher. I definitely see this trend going higher. Absolutely. On a daily chart, we could just keep going. We're at this trend. We're almost breaking out. But at some point, we're going to have to gain some support. We're going to have to go through a negative trend here. We could even just stay flat. But there you go. Now let's talk about some fundamental reasons why the US is in rough shape. So the Fed is tightening. They're tightening the balance sheets. They're raising rates, and this is just putting pressure. And that what they're doing is called normalization. Now, back years ago, rates were much higher. Everything was much higher. So normalization refers to going back to the old standards of higher rates and a thinner balance sheet. So nowadays we have very big balance sheets. We have extremely low rates, which they're trying to rise. And not only are the Fed raising rates, the market is selling off their bonds, which are increasing those yields. And that's also putting pressure on mortgage rates and lending in debt markets, putting humongous pressure. That pressure is going to be felt, and it is felt. Consumers are borrowing less money. So, what's that mean if consumers are borrowing less money? Well, they're spending less. Consumer spending is going down. And we see a tie-in with productivity decline as the labor market, the price of the labor market goes up. So labor is going to become more expensive and productivity is going to go down. It's an inverse relationship. And see, it's not just about jobs. You can have very low unemployment like we do right now, government numbers, at 3.9%, but what do those jobs mean? What are those jobs actually made of? Well, we see a lot of part-time jobs. In a recent jobs report, we saw a lot of larger companies and firms hiring more people than smaller businesses. So it was really those big businesses that needed that extra hand. And the labor market, it's full of part-time work. It's full of service sector jobs that aren't productive. This is a problem. You know, when and this labor is going to get even tighter and tighter. So that's going to mean that it's going to cost more to pay your laborers. That's going to and we're going to see that productivity decline, just like in '08. Okay, so there's an inflationary pressure on the market. We saw the wages tick down with the inflation. The PPI kind of remained the same. That came out today, PPI. And the PPI kind of said that so the core PPI was unchanged at 2%. The PPI kind of came out below expectations. So it was a positive number. That means there's less inflation. I believe the dollar took a hit because of that. I'm not really sure the relationship, but the dollar did decrease significantly. I don't know if that was just, I mean, it almost seemed too fast to happen from, you know, just from technicals. You know, it seemed like this had to be driven by something, a catalyst. Okay, so we got that inflationary pressure. It's kind of coming and going with the wages, you know, but oil, food, energy, housing, some commodities are going up. That's generally what's been happening. Anything where the government gives out money, this lending rate, you know, that's really where the money is going. That's really where that inflation shows. So housing prices, when the housing markets, I would say they're peaking. They're close to peaking here. You know, I think the only reason why the prices are so high, it's because the supply is so low. Why is the supply so low? Because it's expensive to build these houses, and people can't get the money. So if you don't have the money, you can't borrow it because the interest rates are higher. Okay, these are all good fundamental, these are sound examinations of today's market. And now here's some market related fundamentals. So we're at the end of the 10-year bull cycle. Historically, that's something to note. You would want to know, as a technical trader, I look for the deepest pivots and the highest peaks. So, and that's a sign of reversing. When you see a high peak, you know it's going to reverse. Like gold. Gold's spiking up and hitting this percentage, this 23%. You know that you're at the top. You know you're getting close. You're almost touching that upper VWAP. Back down. There you go. Simple example. We also got that 10-year, 2-year spread, guys, that keeps increasing. We are already in that danger zone below 0.5%. So every time it's gone below 0.5%, we've had a recession. And it's just a matter of time before those yield curves invert. And we are seeing a global slowdown. Draghi won't raise rates, and he's being quite dovish. He's not being super dovish, but he's not being hawkish at all. He's saying, let's see what the data says in the coming months. I would say it's going to be slow. Slow. Inflationary pressures. We got oil going up. This whole Iran thing. Trump supporting Netanyahu. Good old Benji boy. What is this, guys? Come on. This is setting up for another war. This is setting up for another war. That ain't good. That ain't good. The government lies, and just know that. Whether it's in the government statistics or whether it's about false flags, just know they lie and be aware of it. Don't follow. Don't listen to the mainstream media. Okay. With all that being said, 17-minute video, pretty thorough, covered a lot of things, reasons why this setup doesn't really look too hot. I just want to see what the markets are doing with you right now, because they could have reversed for all I know. Okay, no, it looks like they're kind of coming back down after a little run up, hitting lows of the day. So I'm just expecting this to decline, continue to weaken, and test support. I think we're going to end up breaking the support, guys. We've been floating at this high range and can't break above it, so we're going to have to test. And again, we did kind of test here at these lows, but we got some stocks breaking out. Kind of crazy. Some stocks are breaking out, but I would say a lot of them aren't. It's why markets aren't breaking out. It's because a lot of stocks are breaking down, rather. And again, this has the itchings of a continuation. It is possible for us to continue. This is 2 transitions on a row for a daily chart. And on this 4-hour, it looks like we're coming down, but this is a transition. So the second half of the day could be quite ugly. Okay, with all this being said, thank you very much for watching. Please like and subscribe. I'm going to try and make more videos focused on one thing and then also talk about markets. But I think that's going to be more beneficial to the community. So thank you very much, guys, and I'll see you soon.